It feels pretty great to get approved for a loan and spend money you didn't have a minute ago. But hey, that feeling doesn't last forever, and if you don't play your cards right, you can easily end up in a financial ditch called a debt trap. In today's video, we'll explore some of the most common debt traps and, most importantly, share practical strategies to avoid them. Keep watching! Number 1. Credit cards. Credit card debt is a very common debt trap most people fall into. Records say that 56 million American credit card holders have been in debt for at least a year. Finance experts call them a double-edged sword. When things aren't going so well and you need some cash to keep you afloat, your credit card can save the day. On the other hand, mishandling it can put you in a lot of trouble. How does this happen? Well, here's an example. Let's say you borrowed some money for a little hiccup, and you failed to pay before the deadline. You've just put yourself in a position where you get slapped with the famous late payment fees. Most of the time, the amount you're required to pay might be $2,000 or even higher. That's a lot of money. And if you fail to pay it on time again, you'll owe them even more. There are other exorbitant fees that can cripple an already financially challenged individual, including cash advance fees, balance transfer fees, hefty over-the-limit charges, and even annual fees. So how can you avoid this? The answer is right in front of you: cut frivolous spending. As a matter of fact, most people start seeing signs of the trouble ahead before it hits them completely. A very good indicator is your EMI outflow. Experts suggest that it should be less than 50% of your monthly income. Once it's more than that, that's a red flag. Your fixed obligations to income ratio is also an indicator of potential debt traps. A 50% FOIR is okay. Even a 55% fixed obligations to income ratio isn't so bad. But once it starts to exceed a 70% threshold, there might be danger. It includes expenses you can't really do anything about, such as rent and school fees. You need to maintain a balance since you need a minimum of 30% to cover any additional expenses and your savings. This will help you avoid falling into a credit card debt trap. Number 2. Payday loans. This one has to be the worst of all. Nothing else swallows your money the way payday loans do. This financial pit starts with you asking for money before salary week. Let's assume you write a $1,700 check to someone who lends you $1,500 for 3 weeks. At the moment, it feels like the best thing to do, and you say something like, "What's the worst that could happen? It's just $200. If all goes well, when your next payday arrives, the lender deposits your check, and it's done. However, a more likely scenario is one where you end up defaulting and asking for an extension. This time around, the lender will expect $400 after another 3 weeks, which they have granted you. If this keeps on happening, you can imagine how much money you'll be paying at the end of the year just because you borrowed $1,500. So, how can avoid falling into the trap of payday loans? A really good way to hack it is by contributing to an emergency fund. You don't have to be knee-deep in debt before you realize that an emergency fund is necessary. Life is very unpredictable, and even after you've done your best to make the right plans for your future, things can still happen. When you find yourself in a tight situation like this, it would be great to have an emergency fund that you can fall back on. This way, you won't have to dip your hands into the funds for your upkeep and survival. If you're already facing trouble with a lot of debt and don't know what to do, Mark Charnet proposes a debt consolidation. He says you should consider a debt consolidation loan that will combine all the creditors into one payment and one creditor. You should do this with the lender that offers you the best rate and terms. Number 3. Mortgage refinancing. According to a survey, 62% of American homeowners occasionally had trouble making their mortgage payments on time. So it's easy to understand why mortgage refinancing sounds tempting, especially when interest rates dip. I mean, who wouldn't want to pay less on a mortgage every month? Besides, you might even bag some extra cash. Unfortunately, this isn't always the case. The lowest rates are usually only given to people with impeccable credit, which you probably don't have. There are a lot of downsides to this. Let's say if you qualify for a low rate, are you willing to spend another 30 years of your life paying for the mortgage? So, what are the ways to avoid this? First of all, you have to carefully look at the offers given to you, including the origination fee and closing costs. Some of these added expenses are jaw-dropping amounts. A single-family home might require you to pay over $5,000 in addition to debt. Also, stop thinking of your home as an ATM. The reason for a 30-year mortgage is to be free of house debt by the time you retire. A solid way to avoid mortgage refinancing is to budget realistically. Make a budget that accounts for all your housing expenses before taking a mortgage, including principal, interest, property taxes, and homeowner's insurance. Make sure that the total amount of debt you have is less than 50% of your net income. You can also consider a higher down payment if you have the money. A higher down payment lowers the total amount of interest paid during the loan period as well as your monthly ME, as it reduces the loan amount you need to borrow. Number 4. Pawnshop loans. If you ever find yourself in a financial bind and you've exhausted your other options, a pawnshop loan doesn't sound like a bad idea. It can help you handle the situation quickly, but you should know that there's always a catch. To get that loan, you're going to have to drop a valuable piece of property as collateral, and guess what percentage of the item's resale value you'll get? Just 50%. You can start to see why it's a debt trap and isn't a great idea after all. You won't have to pay for some time. The loan period can last for up to 60 days. The interest can range from a meager 2% to a whopping 25%, depending on how desperate you are. If you can't meet up with the agreed date, do you know what happens to your valuable property? It gets sold. A good way to avoid a hitch like this is to create and stick to a budget. Dave Ramsey says you will either learn to manage money or the lack of it will manage you. This is a pretty obvious one, but most reckless spenders need to hear it anyway. When we talked about having an emergency fund, we mentioned the fact that unexpected things can happen. But 9 times out of 10, our misfortune is of our own doing. And that's a wrap. If you found this video helpful, make sure you give it a thumbs up. Subscribe to our channel for more valuable content, and share it with others. See you in the next one.